Hey guys, thanks for coming in. Welcome to the webinar that we're doing today, Day Trading Market Structure Secrets with Anomalies, Retags, and the Order Flow Powerhouse. Differences that make a difference. I'm Rob Mitchell and I'll be presenting today. I got a lot of really cool stuff to show you. Without delay, let's get rolling with the webinar. I'm going to cover a lot of materials, and so you might want to take a couple notes. First off, past performance is not necessarily indicative of future results. There's a risk of loss trading futures. Don't use the grocery money to trade. I'm going to show you some really cool concepts today. We're going to essentially build a trading system using concepts that work over and over again. And so at the end of the webinar, I'm going to give you a link to some important resources, so stay tuned for that. I'm going to cover a lot, like I said. You might want to take some notes. You might have heard at one time or another that price action trading is king. And today we're going to take that concept and we're going to expand it out into multiple scales or time frames. Some people refer to it as time frames, but it's not necessarily time. And so I like to think of it more as scales. And we're going to use that to create some actionable trading patterns, situations, contexts for intraday trading or day trading. Yeah. So some key concepts today. We're going to cover anomalies. That would be at the 30-minute time frame, if you want to call it that. And then we're going to expand that same concept into a concept that we use called pivot retags, using 5-10 brick chart that we'll cover. And then we're going to take a look at what happens when we apply some order flow support resistance into that equation, which is a similar concept. Each one of these anomalies, pivot retags, order flow support resistance is becoming increasingly more micro. And so we're working from large scale down to smaller, faster scale. And then we're going to look at some order flow momentum to put into the equation to build out yet another system. I'm going to show you two trading strategies, systems today that are tradable. And then we're even going to combine them using smart trade markers. I'll show you how we're going to do that. So we're going to expand these concepts into an actionable trading strategy and cover associated concepts to help understanding market context and notions like probability stacking and progressive probability stacking as things form in sequences and things like that. Yeah, so I'm going to do this with the same chart so you can see the relationships as we go down these timeframes into increasingly more micro kind of space. So each one is going to have the same chart on there that we're going to look at, and so that'll make it possible for you to see the relationships of all of them together. Yeah. So first off, market anomalies. Yeah, we said 30 minutes. So under normal circumstances, and most of the time, alternating 30-minute periods overlap. And so what we have a tool called the smart periods. We're going to lay that on the chart, and we're going to take a look at how those 30-minute periods interact, how they overlap or not, and just the generalized profile of how the market expresses that throughout the day. Yeah. When periods don't overlap on every other one, it's a strong indication of momentum and range expansion. Yeah. And further, it's an indication that tighter metrics of the same concept can be used for trading. Yeah. And like I said, we're going to go down the time frames here. So this is the 30-minute that we're going to look at. Yeah. And so this chart here is a smart super Renko. There's two different bars on here. There's a 10-tick bar and there's 5-tick bars. Yeah. And then laid over that, we've got the smart periods indicator, and that lets us see the 30-minute periods mapped over or on top of the trading chart. Yeah, so we don't have to have multiple charts to keep an eye on this sort of thing. And so if I start here at -2 period, A period is the beginning of the day, and then it goes through for this market. This happens to be crude oil. This applies to any market. This goes through K period over in here. And so if I start at -2 and then I jump over one period, remember I said every other period, if I jump over, I asked the question, did I touch that last prior one? And the answer is no. So I have failure to retag. It's leaving a space in here. And then the market goes higher, and you'll notice that in B period, it had touched the -1 there. It had touched it and then moved away from it. And then we came higher here, and then we continued higher again. So when I jump from A to C, every other period, I left a hole in the 30-minute chart right there. Again, failure to retag. Failure to retag. B retag in the beginning of the period, and then traded away. And I have failure to retag here. And then this goes higher and trades higher here, and it doesn't touch the D, doesn't touch the B. And so failure to retag there. This was a couple days ago I did this, actually on the 23rd that I did this, built this webinar. And then going higher again, we've got C period, and you see E comes down and it touches into the C period right there and closes that anomaly. I could call it a retag, or I could call it closing the anomaly, closing the anomaly. And F period goes from there. It starts out pretty much at the D period high, still comes back and touches inside, and then it tries higher. There's no overlap from F to H, and there's no overlap in any of these, so I didn't mark them there for you. So you're just looking every other one. Did I touch it? No. Okay. So it's like a gap or a breakaway. Oh, on this one, A to C, did I touch it? No. And so this interval of the day was particularly high momentum. And then you saw it got a little bit lazier about doing that as it went, and then started moving sideways. So you are getting retags over in here. And so that's the market anomaly concept there. And for this one, I decided to do several charts, because we're going to take this exact same concept and we're going to start applying it to other intervals. So here I've got -1 down here, and B failed to tag it. Failed to tag it. And then C was inside. It didn't go higher. It did overlap to the A. And then we left this one over here, and then D period came back and closed this anomaly. We call that closed the anomaly, or covered. Now on most of the time, the market doesn't leave a lot of anomalies. So you saw that last chart we did, it left a bunch of anomalies on there. And on this chart, we're not seeing so much. We got a failure to retag, but then it touches it. And then when it goes higher again, you see G period comes back and touches E. H goes higher, but there's overlap there. We get I inside and it goes higher. And so by the end of the day, there are 0 anomalies left on the chart. 0 anomalies left on the chart. And another concept we're going to throw around, if I've got that -1 there and we start going back towards it, that we can start thinking of that as it's doing it as a kind of a target. We draw that across there, that actually can become some kind of a support resistance level, as we test it at multiple times, trade away, test it, trade away, test it, trade away, test it, trade away, test it, trade away, and then it goes higher. All reference to that initial thing there. I got another chart here. I'm just going back in the days. This is the 21st. We started on the 23rd, I think. I got -1 there. We got overlap there. Trade away here. We left an anomaly right here to the A period low. Left an anomaly there. Left a little bit of an anomaly here. I didn't mark them as like I did on the earlier charts, because by now you should be seeing these. It's just you're leaving a gap there, leaving a gap there. And then this comes up and it comes pretty close to closing that anomaly right there. And there's still another one left at A, and then it comes all the way up and it covers the anomaly to that A period low. Yeah, covers it. And then it gaps away there, leaves one there. This comes down, touches it, and trades away. Yeah, covered and go. Yeah, cover and go. So you cover here, you get selling, cover here, you get buy. Yeah, kind of like support, resistance, targets, these kinds of concepts. Let's see if I did another one. No, I think I just did those three for you. So I was hoping that would be enough examples for you to get it. So as previously mentioned, once a market starts to move towards an existing anomaly on the smart periods of 30-minute boxes on the chart, it can be considered to act like a target for some future point. You could also think of it as support and or resistance. Yeah. But once it starts going for it, it starts getting a little bit of glue, because most of the time, if you go study charts, go study lots and lots of charts, most of the time by the end of the day, there aren't a whole heck of a lot of anomalies. Now, on this particular market that we've been looking at, there's 11 periods in the day, but we start back, you know, -1, -2 period before the start of the day. And so maybe there's like 11 of them there. And so about 80 to 90% of the time, they're going to be closed by the end of the day, you know, somewhere. What's this one? I think this is another anomaly chart. Yeah, so I did do another one. This one was for the 20th of the month. Yeah, A period comes back, touches there, trades higher there, touches there. Yeah, overlap, 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 overlap. And you break away here, and then you get this consolidation, and then you get this breakdown, and then the market comes back and closes the anomaly. So by the end of the day, there are 0 anomalies left on the chart by the time you get to here. Yeah, 0 anomalies left on the chart. So let's go over these principles again. Under normal circumstances, and most of the time, alternating 30-minute periods overlap or they get closed. You know, and when they do not, when it leaves a gap, it's an indication of strong momentum and range expansion, you know, or trend. You know, there's another word for that. Further, it's an indication that tighter metrics of the same concept can be used for trading. Yeah, and on this next slide or the next one, we're going to go to a tighter metric. Yeah, so once the market starts moving towards an anomaly, it can become like a target. Yeah, so just kind of recapping all those. So next, we're going to go to pivot retags. We're just structurally building forward here, and we're funneling down the time frames into smaller and smaller scales. So a pivot retag works on the bars themselves. Yeah, the pivot retag acts in a similar manner to anomalies and has a similar statistical profile to what we've been describing. In other words, you could say it's fractal. What do I mean is fractal? This means these patterns tend to behave similarly in different scales. You know, sometimes people use that word from chaos theory. You know, tends to behave similarly in different scales. So the Smart Super Renko is the bar that we had on the charts there. And like I said, there's a 10-tick reversal bar and a 5-tick continuation bar on the way that bar's set up. And what we are doing there is we're using the reversal bars or the 10-tick bars as an area of support or resistance on the chart. You know? So we identify prior pivot areas using those reversal bars on the chart, magnitude 10. You know. Now, often markets retag these prior areas, and when they do and reverse again to the same direction, you often get continuation of the original trend. In other words, you close anomalies. Yeah, if we're going to use the same language we were using for the anomalies. For the similar pattern. So this is the same concept as anomalies and has a similar statistical profile. So let's take a look at how some of these work. Yeah, this is like I said, this is the same chart that we used earlier. Yeah. And so here, when the market, what we're looking for is the market to come back and touch that. So we're kind of using that like it's a value area. Yeah. And so market goes higher right there. It leaves an anomaly on the to the earlier period, trades away, trades higher. But you'll notice that when it comes down here, it does not touch that, leaving a anomaly or failure to pivot retag that area right there. And then it comes up, it goes a little bit higher, and what does it do? It comes back and it touches that, touches the yellow box. And I actually allow for that to go through it by a little bit more too. We call that a 5-tick trap on this particular type of a chart. And then it trades higher and it leaves the anomaly. This is the same chart we covered before with the anomalies, leaves the anomaly there. And then it makes a dip right here, but it doesn't pivot retag. And then we get this right here. And when you get this pattern right here, it comes back and it retags that initial area, and then it trades higher yet again, making a new high right there. And then this comes back down and it doubles and it touches that area and trades away from it. And then this comes and touches that area and trades away from it. And then this comes and touches that area and trades away from it. This one is a failure to pivot retag. It missed it by 1. And then it pivot retag right there and went a little bit higher. And then it came back and it cleaned up that anomaly. Yeah, there's a failure to pivot retag right there. And then it came and it did the retag right there. We call that a secondary pivot retag. Now market goes higher right here. It doesn't retag right there. And then it goes higher right there. No retags right there. And then the market does this. It completely encompasses that region right there. We call that an encompassing pattern. That's kind of a trapping pattern. And then the market trades higher from there. No retag right there. And then we come lower right here, you retag right there, and the market goes lower. Now, this is the pivot retag concept. We've been using this in our trading room since 2014, and we've created whole statistical profiles around the behavior and the metrics on these bars. And let's see, I think I just did that one chart for that one. So that's the pivot retag concept. Pivot retags act in a similar manner to anomalies using the Smart Renko price bars. And the Super Renko identifies prior pivot areas on your chart of a set magnitude. In this case that we just use is 10 ticks. Markets often retag these prior areas, and when they do and reverse again to the same direction, you often get continuation of the original trend. This is the same concept as anomalies, has similar statistical profile. Pivot retags and anomalies are most often sequential. They happen in order. When they get broken, the market is trying to tell you a story. And the story it's trying to tell you is, I'm not playing ball. And so that little line right there is an important one. Important one. Because if you're getting sequential, it tells you that all the different participants in the market are trading the same way. Trading the same way. And that's an important concept that I'll elaborate on in a little bit. So within a trend, what we're going to do now is we're going to add order flow support resistance into this equation. We're just going to build from there. Same concepts apply to the anomalies. So, and I'm going to add that to the chart in a minute. We're going to take a look at it again. So within a trend, given the above two patterns that we just looked at and the geometry associated with them, the market will similarly alternate between extensions going in the direction of a trend and counter moves. So a market goes up for a bit, it comes back down. Usually it goes up more than it comes back down if it's an uptrend, and then it makes a longer leg going up and a shorter leg going down and a longer leg going up. Like that is the general shape or geometry. See, I use that term geometry there. When the market returns to a prior area of order flow momentum with the support resistance that I'm going to show you in a minute, When it comes back to that, it's similar to making a pivot retag or closing an anomaly, you know, and that becomes a departure point if it reverses back to the original direction. So that's similar to an anomaly pivot retag, and that's occurring on yet a tighter interval or range. You know? So we're going from 30-minute, we're going down to a 10-tick structure, and now we're going down into like a five-tick kind of structure. You know? So if this pattern is persistent, the order flow trend continues. Yeah, continues. If it's broken or non-sequential, the potential for continuation is suspect, like we were just talking about. Yeah, whether that's happening on the 30-minute or the pivot retags or what I'm about to show you. If it's broken, it's suspect. The market's trying to tell you a story. I'm not playing ball, right? So further, as long as it's persistent and you're getting, it's playing in sequences, it's an indication of strong trend. And it's been said the trend is your friend. And I have seen that to be very true. So we're going to take this order flow support resistance tool. It's called Smart Super Trend. We're going to put it on the chart. And what that's doing is it's taking order flow and it's converting it into support and resistance levels. So it's treating it, what it's doing is it's marking on the chart something that's similar to a pivot retag that we just covered. And the way I'm going to do it is I'm going to just put a yellow tick on the chart, and it's going to be right below the price bar. And it's only going to happen on the 5-tick bars, not on the reversal bars. We already did the reversal bars with the pivot retags, right? Now we're doing it on the 5-tick bars on the chart. And if the market trades, so here's kind of the rule, yeah. If the market trades to this prior level and then it hooks it or encompasses it back in the same direction, same as the pivot retags or the anomalies, then it can be treated the same as an anomaly or pivot retag with similar statistical profile. We call this a hook a yellow pattern, you know, hook a yellow pattern. So we've covered all this in 3 dimensions: anomalies, pivot retags, and the yellow ticks. The breaking of a yellow tick is often the first sign of market reversal, making that an important indicator on that metric alone. And when we've got the hay pattern or the hook yellow pattern, especially if it's in alignment with the other factors or other metrics that we use, using other tools that we use, forward or future movements can be predicted with even higher theoretical historical probabilities. The hay pattern will always occur within the pivot retag structure. So because the pattern occurs within that structure, we can expect some level of what we call probability stacking. I'm just going to cover this briefly, and then we're going to look at the chart. I know it's been a lot of slides here, but just giving you information on how all this stuff comes together. Yeah. So probability stacking occurs when multiple contexts of a known probability line up and support one another, to the general rule of when you get 2 of them lining up, and if the probability for each of them to continue is 75%, you get a generic theoretical probability of about 90% to follow through. You know, this is called Bayes' theorem, for those who know what that is. I'm not going to get into Bayes' theorem. There's a lot of really cool stuff about Bayes' theorem that can really help you to understand your trading. So let's add the yellow ticks and see what we get on the hay pattern. Now we're going to use smart Trademarkers to map this out. So you can see that we've got the same chart here, yeah, that we've been using. And we've got these yellow ticks. Yeah, we've got these yellow ticks. And I would submit that you'd rather be trading in the direction of the trend or in the direction that the 30-minute periods are breaking and the anomalies and the pivot retag structure than to go against it. But then I'm going to show you some tricks where you can probably go against it. We're going to take a look at that too. Okay, so this pattern is called hook a yellow, just the hay pattern, and there's a yellow tick right there. The market came higher right here. It suggests to us is going up, and then this comes back down, and you see I drew that magenta line there. See how this reversal bar right here hooks that that yellow tick right there? Yeah, it hooks it. Yeah, and then you get continuation. I had another yellow tick right there. It didn't quite hook it, but it was close. You know, that's why I didn't mark it on there. But I did get one right there, and I did interact with it and hook higher, and the market continues. I didn't quite get to the yellow tick right there, but actually I did touch it in the tail of that bar right there. And so that does actually qualify. Yeah, higher. And then there's a yellow right here, and we hook the yellow and presses higher. Yellow right there, the tail goes through it, goes higher. This is a interesting case right here because we hooked the yellow on the next bar, but that's not one that we're covering here in this webinar. Then we have this yellow right here that's going higher, and we hook it right there, and we get one right here, but we don't quite hook it right there. That was the one where we closed the anomaly back to the C period high. Yeah, and we didn't get any over in here of this exact specific pattern. The next one I got was over in here. Yeah, over in here. So you take the last most recent tick in the direction of the trend. And if you hook, continuation is supported, yeah, or expected. And especially so if it's with the pivot retags and it's with the anomalies and everything else. Yeah. So I put this into Trademarkers and just looked at it over, I think, a 4 or 5 day period. Just this pattern alone, hook a yellow in any direction. Now, market's been pretty volatile lately. But what I'm most interested in when I do a study like this is, at least for me, it's not as much of a trading system. We've been using this pattern for a long time, like in our trading room and everything. So I don't need to do a whole lot of study on this to know that it's going to work or give a good, a decent result. But what I'm interested in, we're going to discuss this in a couple of minutes, is mostly these probabilities right here. And I'm going to get into how you can use those probabilities in a more advanced way than just the trading system itself. Even though this is a superstar kind of trading system, it's one of the simplest things imaginable. It's just price action trading with a theme or variation of price action retagging based on order flow. Based on order flow. But that 92 and 76%, we're going to come back to that in a minute and discuss it. There's other things I could see on this trade marker report. My favorable excursions are bigger than my adverse excursions. My expectancy is about $156. You could automate it if you wanted to. We'll get into some of we'll cover the questions in a little bit so that I don't lose my train of thought and forget where I am in time. So give me a couple minutes, we'll answer all your questions, okay? So this test was for any direction. When I did the test, I did it for any direction. But if you only took trades, as I'm suggesting you might rather do, with the pivot retag structure, which is one level up from the hay pattern, you'd trade less and probably have better average trade. Yeah. So the hay pattern uses the smart super Renko and the smart super trend to create kind of a quasi pivot retag, based on the order flow. Because when order flow acceleration is occurring on where those yellow ticks are on the chart, the market wants to trade away from those when it comes back through them. It's kind of like a slingshot or a rocket ship. Yeah. So this can also be used in conjunction with the anomalies and everything else. Like I said, you can build a multi-level thing, and if you did that, you'd cut your trading down even more, and your average trades probably go up. Yeah. So there's a lot of different ways to slice or dice this kind of stuff. But this is a specific application of order flow support and resistance in conjunction with market structure. Yeah, I got two inputs to the equation there, basically. So I can also use this kind of method as a context and not just as a signal. since the probabilities tend to linger forward. Yeah, what do I mean by that? Well, for example, in the test that we just looked at, and I started to come back to it, we saw 92% to the first target and 76% to the second target. Well, what do we say on Bayes? 275s is 90, yeah? So if I go to that first target, and I haven't gone to the second one yet, and I pick up another signal, then I'm going to stack with that 76. It's even possible that I could get other signals stacking up with that 92 at the same time. Yeah, and we call that probability stacking, like I said. So, but for this one, if that one's lingering forward, that 76 for that second target's lingering forward. If another trade sets up in the same direction with that second target, you get what I call progressive probability stacking. Yeah, and that is consistent with the concept we've already discussed. 275 suggests 90 according to Bayes' theorem. Yeah, so therefore, you can think of this as a trading system or trading signals. But you can also think of it as a context for continuation. If you're getting signals that are stacking on top of each other, either sequentially, simultaneously, or progressively. So there are nuances to all this, and I teach that daily in the trading room. So the next one we're going to take a look at is what we call the fade trade. Yeah, that's not my favorite name for it, but that's what we're going to call it here. Now what we're going to do this time is we're going to add the smart volume ratio. Smart volume ratio is a metric, not of order flow support and resistance, but it's a metric of order flow momentum. Yeah. So what we're going to do here is we're going to combine order flow momentum with price action and the yellow ticks, and we're going to create a little system out of that. Yeah. And so we're going to put the smart volume ratio on the chart, and then we're going to see how maybe you could get away with fading these patterns before they even fully set up. Yeah. So this opens a door for potentially bigger trades on a method that's entirely different. These methods won't overlap. They're mutually exclusive, using the yellow ticks and the background color on the chart from the smart volume ratio. Now this pattern, we fade the reversal bar instead of waiting for it to complete. Counter to the background color, and I'm going to show you how that works. And those same yellow, if you missed some of the yellow ticks earlier, there will be a recording for this too, and you can go back and pause the recording and look at those screenshots if you want to. So, but what we're looking for is we're looking for a yellow tick that happens on the same background color, and then you get a reversal bar going against it. It's a form of a trader trap when you do that. Now, this particular method is a little bit less efficient, but it can result in a bigger trade potential. And I'll show you what I mean by that. Yeah. So here's the pattern. Here's the pattern. If I get a yellow tick on there's a smart volume ratio on a background color. Now, if I get a yellow tick right there, and the market interacts with that on a red background. So red background, yellow tick, green reversal. Touch yellow tick on red with green reversal, and then it goes 10 ticks lower. 10 ticks lower. Where else do we get that? Oh, we get it. It happens again over here. Come down and I touch that. Now I talked about using this as a context. You could wait for the hook and know that that's to the left of it, and know that you're getting probability stacking for that. You could. In fact, that's how I use it most often. So like if I see that yellow tick sitting right there and I'm hooking it, and I know that that was a red reversal on a green background, I know I'm stacked right here. That's some pretty good stacking right there. I can fade this one as well. This is a counter trend trade. I just did these tests in both directions. As I suggested, the ones with the trend will be better. The ones with the trend will be better. And you can see This doesn't have the greatest result. I didn't try to do any money management or anything like that. Yeah, but the better ones are with the trend. But we already discussed that. So you can fade there. You can fade there. Yeah, you got the yellow tick on the green background with a red reversal on a green background. Yeah. This one right here. That suggests to me that the market's weak and it wants to go a little lower. Yeah. I could have waited until there, if I was going to take that counter trend trade. Yeah. This one didn't quite interact with it, with the with the yellow tick. I got one right here, and that one got me into some trouble. I got one right here, and it went. Yeah. So touch yellow tick on green with red reversal on green, or touch yellow tick with red with green reversal on red. Yeah. And that is what we call it the fade trade. That works well in other markets too. So I put all this into Trademarkers, and it tallied up the results. And as I said, you would expect that this one will give you a little bit better result for those first two targets. The last one was like 92 and 76. This one is 87. But if you go look at it, this one takes a little bit more in the adverse excursion department. Yeah, and so you take more heat. You take more heat trading with this. Why? Because you're just blindly, well, not blindly, but you're fading. And if a group of traders gets a hold of it, you might take some heat on it. But so use it as a context, or just knowing that if it's continuing going in the same direction, or you just fade them. The stats for are pretty good. And we've been keeping an eye on this pattern for a good long while now. Yeah. So let's go over some more details on this. We only treated one application. This one's the simplest form. It requires interaction with the last most recent yellow tick on the same background color. Yeah. And there are others that are beyond the scope of today's webinar. Like we saw that one where the yellow tick was away from it. You can use it as a context for that kind of thing as well. The fade trade can also be used in conjunction with other patterns like we discussed. You can use it with a pivot retag structure, anomaly structure, progressive probability stacking. You can use it in conjunction with other indicators we use, like the trap trader oscillator advance and etc. Yeah. So I had these two signals that we just did, and what another cool feature of Trademarkers is we can combine those since they're mutually exclusive, particularly. Yeah. And so I put those together for the week or so for this. I didn't use any break-even stops or any money management kind of stuff or anything like that. But this is the two of the systems that we just created and looked at combined. Yeah, combined. This number over here is a metric that I developed called the edge, and that is the amount by which you are beating break even. And so actually that number alone, those numbers alone give me a pretty good idea of how good a system is. Most brick and mortar businesses just operate on an edge of 1 or 2 or 3%. So average adverse excursion is a good bit less, and pretty good little system. Now, I haven't mentioned Trademarkers that much in this webinar, but Trademarkers has been a big game changer for us doing this kind of work that we're doing. All the kind of thinking behind what we're doing. I can go into Trademarkers and mark these things and just get stats on them like really quick. You have an idea, boom, 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 boom. Okay, I got stats on it. Yeah. And so it's a really powerful tool for identifying contacts, trading probabilities, probability stacking, and everything that we've been discussing. So let's put all this together. So given all the above, we took market trend concepts in 3 dimensions: anomalies, pivot, retags, yellow ticks, order flow, support, resistance, order flow, momentum. And the concept behind each of these patterns and statistics associated with them are similar, or fractal, or whatever you want to call it. So if we know this, then we not only know when the market's trending, but we also know when it might be reversing, as we had discussed. Because often, you look at these things as a sequence. Often that first thing that happens is that yellow tick gets broken, and you don't get a reversal that can happen and hook a yellow. So failure to hook a yellow is your little circuitry in your brain for suspicion. Is it stage 1? What do they do in the military? They've got different levels of, DEFCON 1. So these 2 situations are important to know when trading, and I cannot overstate them. Cannot overstate them. Hopefully that's helpful for you. So the sequence of these geometries, they tell a story. And it's a story that entices participants to one side over the other. Now, a lot of people don't think about what I'm about to tell you too much, but it's super, super, super important. Having participants in the future tense on the side of your trade is at the absolute essence of successful day trading or trading. Somebody's got to carry your trade to success. You got to make sure those guys are on your side to the best that you can. Future participants is the group of traders who ultimately carry your trade to success. Ultimately carry your trade to success. So as each of the metrics that we've been covering in here are in alignment and sequence, what happens is the probability that more future traders, and I'm not talking about futures traders, I'm saying more traders in the future are going to be going your way, theoretically improve. Simple concept. Simple concept. But it's the fundamental concept behind the way markets work. So these methods that we just did, there's no optimization in them. We didn't go in and optimize and run brute force optimizations or any of that kind of thing. Could I possibly improve, the methods that we did? Sure. Sure I could. But what I'm, like I said, when we looked at that first Trademarkers stat profile, I'm looking at those percentages the way I think about these things, because I'm looking for stacking with Bayes concept. So the key concept is that the system was built from components that are known to have an edge. And preferably multiple of them. That we can combine to make a system that's likely to work. And if you base this on fundamental principles that are grounded in the way markets work, then you don't need to worry about optimization or any of those kinds of things. You can still do them, but that becomes secondary or even tertiary. So these concepts are a broad stroke approach to what's behind a well-designed trading system or method or day trading strategies, And there's a big difference between this and data mining or doing bulk optimization or backtesting. So I expand on these kinds of, we cover these kinds of ideas in our trading room. So another important topic, how easy is it to get a trading tool that has patterns that are 75+% to follow through? I've mentioned this before. Most indicators that are out there are random. They're random. And most trading software or systems take a bunch of random indicators and try to combine them in a way that ends up not being random. That's what people are attempting to do out there. That's what people are attempting to do out there. If you put 50%, 50% is random, If you put 250% in bays, what you get? 50%. Yeah. So it takes a specialized skill set to design indicators that can do this. Yeah. But you want to make absolutely sure that the indicators that you're using are not random. It's not good. Yeah. Random indicators, random result. Yeah. So the actual historical theoretical follow-through rates for these indicators that we've been looking at today, for example, are past 75%. I just use 75% because that's the minimum that I will personally accept. And you certainly don't want to accept, just in my opinion, you don't want to accept anything less than 68% for sure. Yeah, but I prefer better than 75%. For years in our trading room, we hit this like ceiling at 84%, 84%, 84%, couldn't break it. Couldn't get anything better than 84%. And then we had some breakthroughs about the time we got Trademarkers, actually. And we started seeing things like you're seeing today, things that are up in the 90s and stuff like that. Now, is that any guarantee you're going to get that? No, it's not. But it sure improves the probability of you being successful, and then giving you the freedom to hone in your skill and get better at it. Yeah. So for any one component and for any specific context, the numbers could vary. Yeah. So it took me decades before I was able to come up with indicators with these kinds of results. Yeah. Thinking about it every day. So we've covered some proven system building theory and application using Smart Super Renko, Smart Period, Smart Super Trend, Smart Volume Ratio from Indicator Smart. And we've covered how to use your research to stack with other systems. And we can't cover everything in the webinar, so that's what we're covering today, is those two basic systems. Yeah. Now, going beyond, there's a lot of other patterns that I teach, and combining these things together in different ways. There are so many of these patterns. With these numbers at this point. We've been doing this for a long time. It's super important that you hone in on one of them or two of them and not try and trade 450 of them, because you can't keep track of it. Yeah. But many of these methods have similar kinds of hit rates and predictive values, similar theoretical historical value that we've had shown here today, and those can be added together, and so you can mix or match them in different ways and come up with all different kinds of systems with all the different components. Yeah. And that way, it's super important that a trader trades in a way that makes sense to them. And so, a lot of people ask me, "Oh, Rob, which signal or thing should I trade?" And I go, "Well, trade the one you see." Yeah, trade the one you see, because that's the one that you're closest to being able to do, with a high level of success. Super important. Yeah, just keep it simple. So trading in the way that I'm describing, where you break things down into their individual components and let them stand on their own, there's nothing like that. Yeah. The types of systems and strategies we used and the design behind them is inclined to stand the test of time better than traditional ways of building trading systems, because each statistic stands on its own independently and are based fundamentally on the way markets work. Yeah. So you get independent, uncorrelated, simultaneous probabilities that can stack simultaneously, sequentially, progressive. Now that was a mouthful, but I think you got it by now. Yeah. So join us in the trading room, or check it out, the tools out at Indicator Smart. I'm going to give you some resources here in a minute for more on the Smart Patterns trading system and the trading indicators. Yeah, Indicator Smart. The trading room is a live application of these and other concepts. Like I said, there's just tons of different ways we slice it and dice it, and you trade the ones that vibe with you. Yeah. And I think it's the best way to learn in a live environment. You can ask questions, get clarification, and advance your skills and knowledge. The things that we covered today with the anomalies, the pivot retags, the yellow ticks, and everything else is actually part of a larger overall understanding of how the market works. That's very, very powerful stuff. And if you just use the first 5 components of that, you know, maybe we'll do a webinar on that one day. But you know, I talked about the market telling a story. The story doesn't always happen the same way, but the way those things reveal themselves as the market's reversing, like I said several times during this webinar, that gives you reason to be suspicious, right? If it's going to continue or not. And but as these things peel off, the anomalies, the 30-minute periods, the pivot retags, and the yellow ticks, that's a real big advantage for you, I think, in terms of just understanding when the market's not continuing. Yeah, not continuing. There's some recent member reviews and comments that users have sent me, yeah, recently. And I promised you a resource page. You can learn more about the tools and things that we used at indicatorsmart.com/powerhouse. And I don't have to capitalize any of that, just powerhouse. And there's a resource pages there with some links on there, and different things that you can get more information and learn more. Yeah. And at the trading room, oil trading room. Yeah. Be sure to join our mailing list. And when you get over to the YouTube channel, you go over to the YouTube channel. This video, I will probably post this video on the YouTube channel tomorrow, or on the website on both websites. So, you know, if you're asking about the recording, I will post those on the webinars page on the and then also on the YouTube channel. But if you want to, if you want to know when these things are being released, if you subscribe to the YouTube channel, you get you get informed of those when they're posted there, which is a really cool way to do it. Yeah. So I'd like to thank you for coming in. Indicatorsmart.com, powerhouse, oiltradingroom.com. So let me see the questions. I think we covered the one. Yeah, these webinars, so, keeping up with me on the yellow ticks, I tried to mark it all out there, but somebody asked a question about automated strategy. You can automate any of this stuff with Bloodhound. We offer that through indicatorsmart.com. Yeah, you certainly can. Yeah. So Tim's asking about, does the anomaly pattern also create target levels? Yes. Yeah, you can think of them that way when they start going to them, because in general, let's say that I'm just going to throw the number out there. I think it's a bit better than this. Mike in our room did a big study on this, which actually, thank you, Mike, because when he did the study, it made it possible for me to take the statistics from the anomaly and the pivot retag and everything else. And I was like, okay, these are behaving the same, because he did a study on it and he came back with the numbers. But for the most part, I'm not going to stick my foot in my mouth, but 80%. Yeah, 80% of the time, the day finishes without leaving any anomalies on the chart. So, if you start getting the reversal, how do you know the reversal? Well, sequences, right? Okay, first thing that happens is you're going to go through a yellow tick where the reversal is not able to hook it. Yeah. Next, you blow out the pivot retag structure. Next, you blow out the anomaly structure of the 30-minute highs or lows. Yeah. And then you're cycling and pivot retag and going the other way. And then if there's an anomaly left down there, the market's saying about 80%, please come tag me. Now, is 80% the best number in the world? It isn't. 6 years ago, I would have thought that, hey, that's pretty awesome. But these days, not so much. But if I know that I've got that market's trying to go towards it, then what we call that is pulling. So if I'm firing a trade where the probabilities, say 87% to continue, and I know I've got that pulling on the other side, then am I getting probability stacking from that? And the chances are pretty good that I am. Yeah, that's a pretty broad subject. I mean, we could do 5 webinars on what I was just talking about. So, but I covered the stuff in the trading room. Yeah, so Adam, go over to oiltradingroom.com. You can use a coupon code over there, Black Gold 249, Black Gold 249 coupon code. Kevin is saying that he makes a, thank you, Kevin. Kevin's a very special human being. Just put a comment in here. I'm making a second living from you. I'm very grateful. Thank you, Kevin. That means a lot to me. Gonna make me cry, man. I don't do free peeks in the trading room. You might imagine by the kinds of things I'm showing you here today, we're not, most trading rooms are like trying to sell indicators. That's not what we're doing. I'll never ask you to buy the indicators. You will ask me when you're ready to buy them, because you'll want them and you'll know that they work at that point. But I'm never gonna do some hyped up, trading room thing and try to get you to buy indicators. It's just not the way I operate. We're a pro room. That doesn't mean you got to be a pro to get in there, but you're going to learn a lot, and if you take the time to learn, it could be life-changing. If not, a lot of people come in and kick the tires around them, and are like, okay, this is going to be too much work. So it's to each his own. So why take on the task? Okay, Sergeant Dow Jones. If you have such a good system, why take on the task of a trading room? Yeah, so good question. Why do I do the trading room? Because we are a small community of people like-minded, achieving the same result. And if you might imagine, I've been doing this for 30 years. My fascination is on getting better, and I've lived my life as a trader, and so I'm paying it forward. Yeah, and room members would pay it forward also. Yeah. So that's the kind of thinking that's behind it. I understand the kind of thinking behind your question, but that's not the kind of thinking that's really driving the room. Do I make more from trading than the room? Yes, I do. In fact, even if, to be honest with you, if I didn't run the room, I would probably make more than I make now, because when I run the room, a lot of times it's during the premium time of the day. But that's not what it's about. But the other thing too is, if I didn't have the room, when Mike, a room member, reached out to me, he said, "Hey, you want to start a trading room?" I'm like, "No, no, I don't want to start a trading room." But the room also provides me with the discipline, because I'm kind of like, I might be doing other things, and so because the room is there, I'm there every day, and so it provides a structure for me to be successful within as well. So that could also be the truth for you as well, depending. So do you call entry and exit? As I said, Trader Rick, there are so many signals on these charts. There are members putting them in the chat. I will point out the ones I'm looking at. It might not be the ones that you are looking at. Yeah. Can you review our performance? The only thing I can really tell you, because this is not a trading system, it is not a bona fide track record. There are so many signals in our room that you couldn't even begin to keep track of them. So how could I call them out? But I'm usually pointing out what it is that I'm looking at. And so from that viewpoint, yes, I am. And the entries and the exits are on the reversal bar. The entries are on the reversal bars. First target is 5 ticks. Second target is 10 ticks. Third target is more. Yeah, and we talk about money management and everything else along with it. So do I call out the trades? Yeah, I do, but I don't say buy, 5 at such and such a price. It just, don't do that. A lot of times this stuff's happening so fast. But like I said, traders in the room are putting that stuff in the chat and everything else. Kevin, who just poured out his heart to me and made me all sentimental. A lot of times he's putting what he's doing in the chat. Other members as well. Yeah, members that share all kinds of things. Yeah. So, yeah. So, Calvin's asking, do I show a live DOW or chart trader in the room? No, I don't. And again, the reason that we're not doing that is because all different traders in the room are trading all different kinds of signals, and we're talking about all different kinds of signals that are happening on the charts live. It's not like any other room. It's not like we got one signal. I just showed you two, I just showed you two. You could come in the room and just trade those. It's on the chart. Yeah, you could. But there's a lot more to it if you want to learn it. You don't need to, but you can. So, if you want to learn about trading, that's really what it's about. If you want to learn how to use the kind of methods I'm showing, that's what it's about. So, yeah, there are guys in the room, there are guys in the room making tens of thousands of dollars a month. Yeah. And there are guys in the room that are just learning. So, we got everything from kindergarten to PhD level in the trading room. So, all right, guys, that's all the questions that are there. I'd like to thank you again for coming in. Indicatorsmart.com/powerhouse for some resources there. If the kinds of things that I'm talking about today, vibe with you, if it makes sense to you, then consider joining the trading room to learn more. Yeah. So, okay, guys, thanks for coming in. Yeah, thanks, Wayne. All right, guys. Thank you. We'll see you next time.